If you're a busy, high-income professional interested in real estate investing, you may be asking yourself, should I invest in single-family or multifamily real estate? Even if you're an experienced investor in one asset class, you might be asking if you should diversify and invest in maybe other asset classes. And in this video, we're going to look at both single and multifamily real estate, the pros and cons of each, and which would be better for you to choose based on your own goals. And if you're new here, I'm Dr. Jeff Anzalone, a periodontist on a mission to get you out of the rat race. Do me a favor, download the free passive income guide with the link below the video. So let's start off with single family and the different advantages of it. So single family residences are typically standalone homes, whereas multifamily housing consists of two or more units in a single structure. All right, first, the single family advantages. Number one of the biggest advantages of single family over multifamily is the lower cost of entry. Now, typically single family homes require less upfront capital, resulting in lower down payments. Now, there are people in the real estate space worth several millions of dollars that actually started with a single family rental. One of these people that started with this strategy that comes to mind is Grant Cardone. Billionaire now, Grant Cardone. Now, if you haven't heard of how he got started, check out my one-on-one interview I had with the man himself with the link I'll put below this video. Second advantage of single family, easier management. Now, if you're a busy professional juggling, raising a family, you're running a business, maybe you're running a practice, a single family home could be the right fit for you. Now, typically these require less time and management than multifamily homes, as you're only going to be dealing with one tenant versus having to deal with several when you're talking about multifamily. But remember, having more tenants can also mean more significant cash flow potential, and we'll get into that in just a second. Number three, higher appreciation potential. Now, this is another advantage of having a single family home. Typically, these properties have higher appreciation potential over their counterparts in multifamily. This is typically due to location, market demand, and desirable neighborhood features. Now, the fourth advantage is we're going to talk about is the financing and the reselling of these homes. So you tend to have more financing, more flexibility, more choices when it comes to single family homes, because all in all, getting a loan is going to be easier versus multifamily. And then when it comes time to sell your single family home, it's also easier because typically more people are going to be looking for a single family home themselves and not just as an investment. All right. So that is single family homes. Now let's shift gears and talk about the advantages of multifamily property. So number one, in general, multifamily property, they have a higher cash flow potential versus single family, as rent is going to be collected from multiple units within the same property. And this helps to lower rental income volatility because it spreads the risk out across several tenants instead of one. When I was in my residency in New Orleans, my wife and I lived in a fourplex. So the person that owned that building, if we moved out, well, they still had three other tenants that were paying them rent. Also, these tend to have a lower cap rates versus single families. Cap rate is nothing more than the net operating income, which is all of the income minus the expenses. That's your net operating income divided by the value. So these tend to have a lower cap rate versus single family homes, which actually increases their profitability over time. Again, a cap rate is a metric used to evaluate the profitability of a real estate asset. Now, moving on to the second advantage, and one of the most significant advantages people like Grant Cardone, they tout, is the concept of economy of scale. Investing in multiple units in a portfolio versus just one, like a single family home, it allows you to scale up your real estate portfolio much faster. And you're also going to benefit from having overall lower property management fees as well. Number three, the third advantage is risk diversification. Now, if you own multiple units in one property, you can minimize the impact of losing a tenant moving out by owning multiple units in one property. So for example, like I just mentioned, if one person moves out, let's say you're in a duplex, well, you still have the other person paying rent. But again, if you own a single family home that becomes vacant, guess what? No income is going to be coming through the door until you move in a new person. And last but not least, advantage is the wonderful tax benefits. So owning investment properties comes with tons of tax benefits that actually reduce the burden of taxes on rental income. So for single family homes, investors can claim deductions on property taxes, mortgage interest payments, and operating expenses. Well, when you own multi-family properties, like let's say an apartment building, you can get even bigger tax benefits. So when you make improvements right after you buy, let's say an apartment complex, you can actually use these improvements to lower your tax bill much faster. And this is something that you could use with bonus depreciation and cost segregation studies. It allows you to speed up all the depreciation that you're going to get up front. Think of it like a supercharged tax discount that helps you save more money. Now, the question that we have to answer is, how do we decide which investment is the best for our situation? Now, as with any decision-making process, it's best to start off with having some goals that are going to allow you to point you in your right direction, okay? So some of the key factors to consider are the ROI, or the return on investment. You need to determine how much profit you'd like to make and what risk level you're comfortable with. Number two is the cash flow. So determine how much monthly passive income you want your property to generate, all right? Third is going to be very important, because you can always make more money, you can't make more time, right? So the time commitment. Determine the amount of time you can put into finding properties, managing properties, that sort of thing. Fourth is the appreciation potential. Now, consider the potential for long-term growth and appreciation when you're looking at a property's value. And again, the tax benefits. So you want to assess the tax implications of owning different types of properties. All right. Now, as with any investment decision, it's also important to take a look at your own financial decision. Now, this is no different than when deciding between single or multifamily. So here's 5 key factors to think about. 1, look at your budget determination. So you want to evaluate your budget, your income, your expenses, your debts, etc. You want to evaluate this to calculate how much you can afford to invest in a property. Typically, multifamily properties have higher upfront costs versus single-family homes. Second is take a look at your financing options. So you want to evaluate the interest rates, the terms, and the requirements, along with the different types of loan options, before you actually purchase the property. Third, which is really important, is you need to look at your own risk tolerance. You want to determine how much you're actually willing to take. A less risky option, as we mentioned before, would be a single-family home investment. But again, they may offer lower returns. Now, on the other hand, multifamily properties have higher potential income, but come with more management challenges. Again, you have to kind of weigh out the risk and pros and cons to see what's right for you. Fourth, you want to make sure that you factor in the ongoing expenses. So it's a good idea to make sure that you can afford ongoing rental expenses like maintenance costs, property taxes, insurance, utilities, etc., while still generating a positive cash flow. And last but not least, you want to analyze the property's potential returns. So you want to always evaluate the ROI, remember the return on investment, for both single and multifamily properties based on factors such as rental income, appreciation potential, and the market demand. So look, ultimately deciding and investing in single or multifamily properties depends on your own personal goals and financial situation. That's why they call it personal finance, right? It's personal. It's personal to you. So what's best and what's right for you may not be right for me or somebody else. In general, single-family homes are a lower cost entry point with easier management, while multifamily offers higher cash flow potential and economies of scale. Regardless of which option you choose, you want to make sure that you research the local market. Remember, real estate is always about location, location, location. And then make sure that you have somebody that you can consult with, maybe some sort of real estate agent or a mentor, something like that, before you pull the trigger and make any type of investment. Now, if you're like me and you don't have time to deal with the headaches that tenants in either single-family homes or multifamily properties can give you, but you still want to invest in real estate, you still want to get the tax benefits, you still want to get the cash flow, you still want to get all the things that come along with real estate, then consider my favorite investment, investing passively in real estate syndications. If you've never heard about that, or maybe you've heard about those and you want to learn more, check out this video.